think realistically, the dollar's at a bit of a mixed area here. We did see the dollar reverse some weakness in the first week of 2024. The reason why the dollar was falling so much into the end of 2023 was because the Fed pivot had just suggested interest rates are coming down. That means interest rate differentials were going to narrow against other currencies, maybe. And I think we saw traders race to cover some of their weak shorts because that move down in December was quite strong. Then there was a rethink, oh, maybe they're not going to cut in March and maybe they're not going to do 150, 160 basis points. And we saw a reversal. And you can see this clear as day on the dollar chart on the bottom left here. We saw the dollar index up at 104-ish. We started trending lower into the start of the week. And I think realistically, we now may be breaking out a little bit. But look at this. There's no conviction of this move higher at the moment, but it's consolidating. So what next? Do we start going back into that downtrend, or is this downtrend now broken and we start moving back up again? And I think a lot of that depends on market understanding and pricing of Fed rate cuts, but also I think on whether yields are being pushed higher by the amount of issuance coming out from the US as well in the auctions. But I think the resilience of the dollar so far in 2024 could make a Fed rate cut more unlikely, not necessarily because of what's happening with the dollar, because that is a function of what's going on in the bond markets. But the bond markets are beginning to question a little bit about whether March is too early or not. And I think that's going to keep the dollar moving or volatile, because that 2-year area is quite sensitive to what the Fed is thinking. So we're listening to Fed speakers. The problem is the markets are pricing in quite a big cut starting in March of 150 basis points. If we look at the Fed median dots, they're looking at 3 cuts only, not 5. So there's quite a gap between what the Fed is telling us and what the markets are pricing. So the other thing is, why would the Fed want to go early? There is some feeling in the market that maybe they're anticipating early cut due to the upcoming presidential election. It is far harder for the Fed to cut rates near an election due to accusations of political bias. So maybe they want to get the thing done early, plus the fact there's positive real yields now in the US, which gives them a little bit of room to cut. But whether it's going to be March or not, I'm not hearing that from the Fed, but the market is still trading the idea that they're going to be cutting in March. And traders have upped the bearish moves on the dollar as well over the last few months. You can see this on the chart on the right. Hedge funds and some of the big traders have been quite short the dollar. So this bounce, if it continues, could see a bit of a squeeze out some of those potential shorts being squeezed out. So I think this is really quite an interesting thing, that the shorter term market is short dollars. I think there's a risk to that trade, but it all depends. I mean, CPI tomorrow could be a catalyst for the dollar to move. In fact, it could move all assets. The only problem is CPI is usually very rarely more than 0.1 away from expectations, but the whisper number is potentially just a tiny tick higher, but we shall see. And I think we should get some volatility over the next day or so on the back of that. The euro is an interesting one. We got up to that 111.40 level at one point, but we've moved back into a bit of a range. 108.75, 110.50 now for the beginning of the year. As you can see, there's been a lot of talk about EU inflation bouncing back from its recent lows. It has, but a lot of that is base effects. So be careful of being really bulled up about inflation coming back in the EU. I don't really see it in the monthly data, and base effects can give a bit of a distorted picture. And I think that's kind of what we're seeing on the chart here. But there are concerns because the ECB is never quick to move. So they could actually hold on to 4% rates a little longer than people expect, or possibly even longer than they should. What will that do to the economy? And traders have scaled back the scope for ECB interest rate cuts recently, which I find very interesting. But interestingly, within that, the euro hasn't really gone back to its highs. So I think there's a little bit of doubt about exactly what the ECB is going to do next. But I think personally, looking at the data, and this is not a view, it's just looking at the data, I would suggest that maybe the ECB needs to go earlier than the Fed. Whether they will or not is a massively different question. They were slow to hike, and I think there is a danger for the economy that they may be slow to cut. So it's a tough one to call who's going to be first to go. But at the moment, markets seem to think it's going to be the Fed. But to my eyes, the Fed economy looks far stronger than most others. So the euro could stay in a volatile range around the ECB meeting on the 25th of January. But if they are going to start thinking of cutting, they're going to have to start communicating that. So whilst I don't think we get anything from the January 25th meeting, I'm wondering what sort of message they want to send. So that's going to be quite interesting. And I think that could move the euro as well. So I'd like to get Richard's opinion on how the charts look for the euro. Personally, it looks a bit dull to me at the moment, kind of mid-range. But what do you think, Rich?
Yeah, it seems very much that way. I mean, we haven't really seen a tremendous amount of movement that we can see within the weekly chart. There's, yes, we sort of sold off in into the October lows, but we rallied back into the New Year period. Um, and there's not really a lot of information that's coming through from this chart. The interesting point, however, is that we did fail within the upside move at this 62% retracement of the January 21 to September 22 level sell-off at 112.85. The market rallied back to that and sold off very aggressively from it. Now, you would normally anticipate a reactive move, having seen such a strong rally from a 62% Fibonacci retracement. But the sell-off into the October lows seems to be a little bit more significant than that. But what it has done is confirm this area as quite an important longer-term resistance focus. And if this is going to be a prolonged period of euro strength dollar weakness, then we would have to break and close above this 112.85 area to open higher levels. And until such a development, we do still have the potential of a weak test of the previous high. And what I mean by that is that the rally fails below this previous peak, and then we start to see a break lower under the 107.63 Bollinger Mid average, which is now flattening out. And that could well trigger fresh downside towards the October lows, just around about just above the 104.5 area. And so I think the next few weeks' activity is going to be quite important, not only for the dollar, but also for the euro, and really sort of signaling where these directional risks lie. Now, the thing is, when we look at the 4-hourly chart coming into the latest CPI data, we can see that euro dollar has been caught in a very choppy sideways range. To the downside, we had support developing around the 108.84, 62% retracement area. To the upside, it was the 38% retracement of the late December, early January sell-off at 109.78. And I think these extremes coming into the data over the next few days really reflect the important support and resistance levels. So I think we need to see how these areas defended. And it may well be that if we do start to see a breakout either to the up or to the downside, that may well trigger where the market directional risks are beginning to develop. But certainly at this stage, it's very much a decision-making process ahead of this data. And we need to see a breakout from this range to really sort of bring into play those longer term levels that we were highlighting a second ago. So I think it's going to be very interesting, certainly over the data, but these are the levels that I'll be watching to really sort of trigger and develop more significant price movements. But Mo, how about some dollar yen? What are you seeing there? Is that a different story, or is the potential of those movements still beginning to develop there?
I think, Richard, the interesting thing and great presentation on the euro. I love those levels. On dollar yen, I think the fundamentals are different here. I think what we've got, well, we saw basically a 3.5% rally in dollar yen in the first week, has pulled back a little bit since we got up to that 146 level almost, as you can see here on the hourly chart. And that was due to the fact that we saw that rise in US yields, as we showed you earlier, the 2-year yields rising. And, dollar yen is actually a real closely correlated function of US yields because it's the differential between US rates and Japanese rates, which has been driving this. Now, when we saw that big sell-off down to 140.80 a couple of weeks before, that got a lot of people out of that position. But when the market started to reassess whether the Fed could actually cut in March, then dollar yen started to rally. But on top of that, we actually saw some weaker Japanese data, which some people are suggesting may see the Bank of Japan have to delay a potential hike because that data just isn't strong enough. But the move was also supported by a spike from the lows in the 10-year yield as well. So we saw the US yield move higher in the first week of January, and thus we saw this breakout. And we had a very clear breakout on dollar yen on the charts, and that seems to have extended up, and we're back above 145 now. And I think there's a bit of a clamber back to put this, what we call carry trade, back on. But I do think dollar yen could be impacted quite a bit by tomorrow's US CPI print because it is so closely correlated with US yields. So, if we come in higher on the CPI print than expected, expect dollar yen to move higher. If it comes in lower, expect it to move down. But I do think traders are going to be very focused on the BOJ meeting on the 23rd of January for the next big move, because I expect nothing from the meeting itself, but the communication that they're going to be sending us. Will they be suggesting maybe in April the data is strong enough to suggest we're going to hike, or are they going to have to admit that the data so far is too weak to justify a hike so soon? So I think that's going to be vitally important. They're the things to look out for on dollar yen. And for me, there seems to be a danger that if we get a bit of a bid in yields again, we could see dollar yen back towards the 150 level, because it's not a view, it's just on positioning and the weaker data in Japan and the potential for higher yields in the US. But those have all got to fall in place. But what do you think on the charts there, Richard? Because
Yeah, I mean, I think the general backdrop really is that we are still looking at further upside potential for dollar yen from a technical viewpoint. So it's very interesting to hear the sort of fundamental backdrop and Mo's interpretation there. I mean, basically, it has been a very strong rally since the beginning of the year within dollar yen. And that has seen us break above the Bollinger Mid Average, move back towards the upper limits. But importantly, what this is actually saying within today's movement is that the mid average is now starting to turn up, and those Bollinger Bands, as we're tagging the upper band, are beginning to widen. And that reflects positive volatility coming into to price activity. And the risk is that can trigger a more significant move towards the upside as this positive volatility supports levels and sees further strengths developing. So any acceleration from this type of area to extend what has already been a very positive move could see us break above this midpoint, just above the 146 area, and then that 147.44 level of the latest sell-off. But then I think if this point does start to give way, and obviously again it's very dependent on the data over the next few days, then we could be talking back above, towards the 150, maybe above that area. However, to the downside, we would have to break below this rising Bollinger Mid Average, which is currently 143.03, to suggest upside failure and the risk of a revisit to the recent lows and possibly further. So again, it's very much data dependent and how the market starts to develop once we see this new piece of information. But on the 4-hourly chart, again, we haven't got quite such significant volatility creeping in to the 4-hourly picture. We're more of a choppy sideways trading range. So that would suggest that we need to break above this 145.96 January 5th high within the current upside move to bring about that potential acceleration and tests of those longer term retracement points. But certainly the risks are there. And while we're above this 144.43 hourly mid average, that potential is still towards higher levels. But effectively, really, if we're looking at it coming into the data over the next few days, it's a question of this 143.42 January 9th low, from where the market's latest strength has developed, against this January 5th high, with a breakout really needed to suggest where the next directional risks are beginning to develop. So from my perspective, coming into the data and over the data, I'll be watching these levels and really see how the defense develops and whether or not we start to see development of this positive volatility that seems to be creeping in ahead of this very, very important data. So I think, it certainly looks as though it's going to be a very interesting couple of days into next week. And I think that that could bring about some quite important new signals from a technical and fundamental perspective.